Divestment is a difficult decision for a business. The decision is usually long fought and subject to a great deal of debate. There are numerous reasons why companies divest assets or part of their company. We will cover some of the more common scenarios in which companies engage in divestitures. 1. Sources of fund. In times of financial difficulty and to keep the business afloat, businesses might sell off the non-core assets to raise cash. For example, Sears Holdings, a consumer retail company, struggled with declining sales and negative cash flows. In 2014, as part of its survival plan, the company announced a divestiture of its real estate holdings to raise funds to continue reorganizing its retail business. On the other hand, the cash raised can also be used to strengthen the company's balance sheet by paying down debt and reducing gearing. The second rationale is non-core businesses. Selling a subsidiary isn't always a bad sign. In some cases, the company just wants to focus on its core business. Pruning the company portfolio can help reduce organizational complexity, raise funds for the next stage of expansion or change, and focus on the primary lines of business. In 2020, WeWork Corporation, which provides office sharing spaces for rental, faced financial struggles. As a result, the management team announced divestitures of its non-core businesses, including its content marketing and software businesses. The third rationale is the fact that the business is non-performing. Companies often divest parts of their business that are not performing up to their expectations. These divestitures can involve eliminating subsidiaries or divisions that are underperforming, which might in turn help to improve earnings stability. Rarely, a divestiture isn't the result of the company's own choice, but a necessity imposed due to antitrust concerns from regulators, as selling off certain subsidiaries during a merger or acquisition can help prevent monopolies and encourage competition. In many countries, the government mandates divestments to avoid a monopoly and to maintain fair trade practices. Hence, companies divest to abide by the rules. For example, in the 1980s, American telecommunication company AT&T monopolized the U.S. telecommunications industry. The U.S. government forced AT&T to divest itself by selling off assets, thereby allowing other companies to enter the market. Lastly, a sale could happen to unlock value for a company. A firm often breaks up into two or more companies to unlock value believed to be greater for separate entities than that of a consolidated company. This is especially important during liquidation. For example, investors are willing to pay much more for different parts of the company separately, such as real estate, equipment, trademarks, patents, and other parts, than to buy one single company. Additionally, private equity investors usually have an investment horizon of 5 to 7 years. Coming to the end of the investment horizon, the funds might start planning to exit or sell off their investments with the goal to potentially realizing substantial profit on their investment.